Hi all. If you've ever found yourself questioning what truly sets elite traders apart from the rest, you're in the right place. Today we're unpacking the Trader's Handbook, Winning Habits and Routines of Successful Traders, by Richard Moglen, Nick Schmidt, Ross Harbour, and Amit Rai, a powerhouse resource that distills over 60 years of combined market experience into a practical, step-by-step guide. This isn't just another trading book. It's a hands-on manual for anyone determined to break out of the cycle of inconsistent results. In this video, I'll walk you through the essential principles, the stages every trader must navigate, and the proven systems that transform trading from guesswork into a repeatable process. Plus, I'll share practical examples, insights from legendary traders, and clear steps you can start using right away. Let's start with a bold claim. The single most important factor in your trading success isn't your strategy, your network, or even your capital. It's your commitment to learning and your willingness to treat trading as a business and not a hobby. That's the central message of the Trader's Handbook, and it's echoed by every market wizard from Mark Minervini to William O'Neill. The book opens with a powerful story from the late 1990s during the internet bubble. Ross Harbour, then a portfolio manager at William O'Neill & Co., watched as Charles Schwab, one of his largest positions, soared over 400% in just 24 weeks. But instead of getting swept up in euphoria, he recognized the signs of a climax top, sold his entire position, and avoided the 87% collapse that followed. The lesson? Never let emotions override your process. The best traders are ruthlessly objective and always ready to cut a winner when the technicals demand it. So, what does it actually take to become a consistently profitable trader? The Trader's Handbook lays out 5 key principles that underpin every successful system. First, keep it simple. The best trading systems are remarkably straightforward. Complexity adds noise and confusion. Focus on price action, use only a handful of indicators, and make your rules and routines easy to follow. Second, stay focused. Specialization is the path to mastery. Pick one style: day trading, swing trading, position trading, or investing, and become an expert. Limit your attention to a handful of stocks and setups. Third, plan for failure. Every system must be resilient enough to handle losing streaks, bad luck, and market environments where your edge isn't working. Fourth, manage risk tightly. This isn't just a cliché. The book dedicates an entire chapter to risk management, showing you exactly how to calculate and control your exposure at all times. And fifth, think in cycles. Both markets and traders move in cycles. Recognize when to press your advantage and when to step back. But before you can build a system, you need to know where you are on the trader's journey. This book identifies 4 distinct stages: the unprofitable stage, the boom and bust stage, the consistency stage, and the performance stage. Every trader starts at stage 1, where entries and exits are random, risk management is non-existent, and the equity curve trends downwards. If you're jumping from strategy to strategy, chasing tips and sizing positions based on gut feel, you're here. The key to moving forward is simple. Commit to learning, write your first set of trading rules, and implement basic risk management. Stage 2 is the boom and bust stage. Here you've done some research, maybe read a few books, and you're starting to use stop losses. But your equity curve is still volatile, swinging up with the market and crashing down when conditions change. The biggest problem? Trying to master too many strategies at once. The solution? Focus on one time frame, one strategy, and a handful of setups. Refine your rules, gain experience, and start tracking your performance. Stage 3 is where things get interesting. You found a strategy that fits your personality, you follow your rules most of the time, and your equity curve starts to trend upward. You're building confidence, but you still need to master a small set of edges and learn to size up when the opportunity is right. The transition to stage 4, the performance stage, is all about incremental improvements, adapting to market cycles, and concentrating your capital in the highest quality opportunities. So, how do you actually build a system that works? The foundation is technical analysis, but not the kind that relies on memorizing candlestick patterns or chasing the latest indicator. The Trader's Handbook teaches you to read price action in its purest form. Start with clean charts, just price, volume, and a few key moving averages. Learn to interpret each price bar as a battle between buyers and sellers. Calculate the closing range to see who's in control. Pair this with volume analysis to judge conviction, and look for tight price action on low volume as a sign of accumulation, and watch for explosive moves on high volume as a signal of institutional buying. Uptrends are defined by higher highs and higher lows, or by price holding above a rising moving average. Use multiple timeframe analysis to spot confluence. When a breakout on the daily chart lines up with a key level on the weekly or monthly, the odds of a sustained move increase dramatically. And always pay attention to the character of the stock. Is it cleanly trending, respecting moving averages and forming orderly bases? Or is it choppily trending, gapping up and down with little respect for support? The more liquid the stock, the cleaner the trend. But technicals are only half the story. The real drivers of market moves are institutions, hedge funds, pension funds, and banks that account for 90% of trading volume. They're looking for companies with accelerating earnings, new products, and strong growth. The book adapts William O'Neill's CAN-SLIM framework, focusing on current and annual earnings growth, newness, supply and demand, leadership, institutional sponsorship, and market direction. But it also recognizes that in today's market, price and volume often lead fundamentals. A game-changing catalyst, like a new product launch, will show up in the chart before it's obvious in the financials. This brings us to the concept of edges and setups. An edge is a repeatable characteristic that gives you a statistical advantage. The more edges a stock exhibits, the more capital you should allocate. The book's SNIPE framework, search, narrow, identify, plan, and execute, guides you from idea generation to trade execution. Start with broad screens to find liquid stocks with strong fundamentals. Narrow your focus to those showing technical edges, high volume breakouts, relative strength, and participation in leading themes. Identify actionable setups, like the launchpad, gapper, or base breakout. Plan your entry tactic and risk management, and then execute with discipline. Let's break down a few of these edges. The high volume, or HV edge, is one of the most powerful. When a stock gaps up on the highest volume in a year, especially with a catalyst like a surprise profit or a new product, it often signals a character change and the start of a major trend. This happened with Tesla in 2019. The company reported the best-in-year volumes on a gap up when it reported a surprise profit, its new over-the-air autopilot updates, and that a new factory was ahead of schedule. In this case, the HV edge identified the character change that led to a 200% move in a few months. You can easily create a screen for this edge using the logic that volume today is greater than the maximum volume of the past 250 days. Another example is Palantir, ticker PLTR, in 2023. The book points out how PLTR showed huge volumes as it quickly doubled following an earnings report. The relative strength edge focuses on stocks that outperform during market corrections. These are the names institutions are accumulating. Most of these resilient stocks, especially in the last third of the correction, go on to become leaders, reclaiming key moving averages and hitting new highs, eventually leading the market higher. The N-factor edge looks for game-changing catalysts like a change in management or a drug approval that force funds to reevaluate a company, leading to sustained buying. Setups are larger patterns that provide a favorable reward-to-risk ratio. The launchpad setup, which is one of the bread-and-butter setups of the Trader Lion methodology, forms when all key moving averages converge and the stock shapes up within a consolidation. The moving averages used are typically the 10-day SMA, the 21-day EMA, 50-day SMA, 65-day EMA, and 200-day SMA. It's best when a group as a whole is shaping up together and has the potential to lead. For example, Nvidia formed a launchpad in 2023 before advancing 400% in the year. The gapper setup looks for explosive moves on news, while the base breakout setup is the classic O'Neill pattern, multi-week consolidations that resolve to the upside on volume. The key is to focus on the first few bases or gaps in a move, when institutions are still accumulating. This is important because many traders look for these gaps in popular stocks that have already made their big moves, ultimately trapping themselves in a precipitated decline or years of stagnation. Entry tactics are about managing risk. Every setup should have a clearly defined entry point and a logical stop loss. The book details tactics like the key support level reclaim, which can be executed using trend lines as well as moving averages, consolidation pivot breakout, which allows entry before the traditional pivot is taken out, and moving average pullback, when the stock moves back to a key moving average like the 50 DMA. The goal is always the same: enter close to support, keep your stop tight, and size your position so that a single loss is just a paper cut. Now let's talk about risk management, the most important chapter in the book, and the one that will keep you in the game for decades. Risk is controlled by three factors: the number of positions, the size of each position, and the location of your stop loss. Calculate your total open risk by multiplying each position's size by the distance to your stop, and then sum across your portfolio. Adjust your exposure based on market conditions. In strong uptrends, you can afford to take on more risk. In choppy or corrective markets, size down, tighten stops, and focus only on the best setups. Stop losses must be both tight and logical. Place them just below key technical levels, moving averages, swing lows, or the low of the day. Don't set stops at obvious levels where you'll get shaken out by normal volatility, but don't give the stock so much room that a loss becomes meaningful. Once you have a profit cushion, raise your stop to break even, and then trail it behind a moving average as the stock trends. The best traders are right only 30 to 50% of the time, but they keep their losses small and let winners run. Position sizing is another critical skill. Start with a base position, say 10% of your portfolio, and increase size only when multiple edges are present and the market is in your favor. Never go all in on a single trade. The goal, always, is to survive losing streaks and be fully capitalized when the next big opportunity comes along. Let's pause and reinforce a key point. Trading is not about being right all the time. It's about managing risk, stacking small edges, and letting the law of large numbers work in your favor. The Trader's Handbook is filled with real examples, from the 1999 internet bubble to recent market leaders like Nvidia and Palantir. The same principles apply. Focus on price and volume, manage risk, and specialize in a handful of setups. Before we wrap up part 1, let's summarize the core takeaways. First, trading is a journey. You must progress through the stages, build your system, and commit to continuous improvement. Second, simplicity and focus are your greatest allies. Third, risk management is non-negotiable. Fourth, edges and setups are the building blocks of your strategy. And finally, the market rewards those who are prepared, disciplined, and willing to do the boring work consistently. In part 2, we'll dive into the advanced routines, post-analysis, and the exact frameworks for stock selection, screening, and building your own trading rules. We'll also cover the psychology of winning traders, the importance of market cycles, and how to adapt your system as the market evolves. If you're ready to take your trading to the next level, make sure you don't miss it.